Hey everyone, I'm Jeremy Szafron. You're watching Kitco News. If you haven't already, make sure to hit that subscribe button. Now this week on Chart This with Gary Wagner, gold has been testing key resistance levels at around the $2,300 per ounce mark. With the US dollar showing some weakness, gold traders are keenly watching for any signs of a breakout or a pullback from this critical threshold. Now, over in the silver market, volatility continues as industrial demand waxes and wanes. Silver's dual appeal as both an investment and industrial metal is putting its technical indicators to the test. We'll be unpacking what this could mean for its price direction in the near term. And lastly, Gary and I will discuss Bitcoin. The cryptocurrency has recently corrected after a sharp rally. And considering this pullback, what can the historic data tell us about the potential future movements? Is Bitcoin setting up for another major surge, or is this the beginning of a deeper retracement? Our friend Gary Wagner, our resident technical analyst here at Kitco News, joins us now from Hawaii. Hey, Gary, thanks for coming on, mate. Hope you had a great weekend.
I did, and thanks for having me. It's good to do the show when these markets are moving in such an exciting manner.
Yeah, you're not kidding. There's some definite volatility in the markets. Let's start with gold. I mean, we talked a little bit about it 2 weeks ago. Bring that chart up because it's currently testing the resistance level around $2,300 per ounce. Obviously, Gary, we're surrounded by global economic uncertainties. We're seeing economic data every week. We have the continuing geopolitical tensions. Last time we had you on, you talked about the flag formation. What are we seeing now in gold?
Well, we'll get to a flag formation in a second. In terms of support and resistance areas, support is at 2,300, and that is a representation of this extension. I've got a basic fib extension. We use a fib extension if we're going towards record highs, all-time highs, because if we haven't been there before, that's one of the few ways to calculate it. What I've done is put an extension in that goes back to 2022 when gold is at about 1,800 up to about 2,200, this big rally. Then we look at this correction, which culminated a little bit below 1,900 and start charting from there. So from this point here at about 1,900, the extension that is a 618% extension comes in at 2146, 2216, and then the one-to-one relationship. In other words, if we look at this rally here and compare it to this rally here, that would culminate right here at about 2,300. And that's why we're pegging support at this level. Jeremy, you are correct because it was former resistance. Support and resistance are part and parcel of the same thing. So currently this same area is support, and we've got resistance at the 1.236 at 2405. It did exceed that on that run up to the new all-time record high. And then it's come down and found support at about, call it 2,300. And so we want to look at these different areas. We also want to look at the ultimate extension, which is a 1.618. Now, this would be an exceedingly long-term market move, but I'll show you why that's important on the second chart. On this second chart, when we look at it, what we see is that we talked about when we first started the chart, this series, we talked about this compression triangle. If it broke out, it would indicate the market moving higher. In fact, it did. And then we talked about a flag formation right here. And we measured this pole to this pole. This was our extension. And the interesting thing is it came up right around here. It far exceeded that, but I'm kind of seeing another potential flag formation in that we've got our pole here. We've had a sharp decline from these highs right in here. And so if we see gold on a closing basis break above this resistance line right here, and it's at a pretty strong tack, a 53% angle, we could, and again, this is on an exceedingly long-term basis. I'm not talking about in a couple of days or even a couple of weeks or a month, but this would be towards the third quarter of this year to the end of this year. We could test 5,500. But of course, before we do that, this is the key mark to beat, which is the recent all-time record high above 2,400.
Interesting. Okay, so potential for Q3 this year, possibly later this year, that $2,500 gold mark. I mean, there's so many things going on, Gary. You and I have been talking about these all-time highs for months now, and of course, given the recent inflationary pressures and the softening of the U.S. dollars, from a technical perspective, zoom in there and let's talk about the short term of what we could potentially see. I mean, if it's 2,500 towards the end of the year, is this volatility set to continue?
It certainly could. We don't have any resolution to the conflict in Russia and Ukraine. We have no resolution to what's going on in Israel. And so that geopolitical tension is still at a heightened level, unquestionably. Inflation seems to be more persistent than the Fed had hoped for. And so that's why we get these mixed messages from the Fed. They want to cut rates, but they're not going to cut rates if they do not see that the work they've done, putting them on that trajectory to 2%, and they're pretty adamant about that. They have really disregarded their dual mandate, which is full employment and acceptable levels of inflation, to focus on inflation and kind of look at employment as taking care of itself. We've had strong economic growth. So really what we want to see on a technical basis, we're up about $25 today, and it has gone back over what we had as a level of potential support, but it broke through there last week. If it does close above this particular price point, we'll look at first this top at 24.27, and then the all-time record high, I believe it was 24.28. Short term, we want to see if it breaks above this trend line. So on a closing basis, closing above, call it 23.50 to about 23.60. That would give us the technical confirmation that we could be moving higher. If we are, we want to look above 2,400. If it breaks below this, we would look at about 22.25 for potential support. And that is an important level because you have this whole series of candles that come in below that, and it really acted as a technical level of resistance right here. Now we're seeing support come in at this price point.
Okay, the 23.50 on the support side. Interesting. We'll keep an eye on that, as I'm sure traders are, as you mentioned, not a lot of sleep this weekend too, keeping an eye on this market. Let's switch over to silver. I mean, it's been volatile, of course, especially because we have the industrial demand influenced by global economic forecasts. What are the critical technical levels that traders should be monitoring here, Gary? Let's talk a little bit about this and how maybe economic data could impact these levels.
Yeah, I mean, silver has garnered a life of its own. It tends to sometimes move in unison with gold and sometimes not. When it does, it tends to outperform gold on the way up and outperform percentage drawdowns on the way down. I remember this particular day that occurred about 2 weeks ago. That's when we saw silver open at about $29 per ounce and close that day at about $27.50. So it was just shy of $1.50 move to the downside. I believe it was almost over 5%. Today, we've got a rise well over 3%, opening at about 26.86 and currently at 27.68. The key levels that we want to watch, I think the most important level is based on a combination of a 50% retracement. It's not a fib number, but traders have been using that 50% mark in terms of a correction, and it has shown to be a valuable price point to always look at. But the fact that it corresponds with the simple 50-day moving average, that's this green line here, tells me that this is solid and major support at 26.40. It broke over the 38.2% fib retracement at 26.5 cents. And that being said, you have 28 as an important number. It's based on these tops that come in right here. The next technical level is 28.38 with these record highs that came in earlier right at around $30 per ounce.
Yeah, it seems like 30 is that mark, that mark where people are kind of waiting for it to go. It almost touches and then it pulls back. Is that kind of the same thing that we're seeing here?
Absolutely. When we look at a candlestick, you've got the real body. On a green candle, you've got the open and the higher close. On a red candle, you've got the open and the lower close. But then you get the wick. So the wick, the upper wick is the price action from the real body up to the high of the day. And that is right here. Just over $30 is a wick. You can see that right on this one. That's the longest wick we have. And you'll look at lower wicks coming right to support last week. In other words, as it was trading lower, you had a strong down day. You had the market trading sideways, another strong break to the downside. And then you had these series of lows that all came in on Friday, Thursday, and Wednesday, right at around 26.36. And that's why I believe that that is a strong level. Traders that see it coming near the simple 50-day moving average, and that is a benchmark that pretty much is a standard tool with market technicians to look at the short-term support and resistance levels. The interim term, we use a 100-day, and the long term, we use a 200-day, which is 1 year of trading.
Now, I'm curious, we just had some economic data show from the Fed, Jerome Powell, talking a little bit about this potential global economic slowdown when it comes to industrial demand, possibly for silver. We could see that if industrial demand goes down, maybe the demand for silver does too. So I'm curious, could any of this undermine any bullish technical setups? Like, what are we thinking about here in terms of the new data?
Yeah, it certainly could provide some headwinds, right. But what I found most interesting about today's move in both gold and silver, where we had solid moves to the upside, is at first analysts were looking at this, besides the uptick in geopolitical concern with what's going on with Israel, was a delayed reaction to the jobs report that came out on Friday. In fact, on my weekly show and the weekend review, I talked about that it was perplexing that the jobs report came in the way it did, meaning that it certainly came in well under expectations, and we didn't see a sizable move in gold. In fact, we saw the opposite, and the same with silver. This is silver on Friday. Mm-hmm. And it didn't quite jive with what we should see. In other words, there are certain relationships that we look for, and those relationships get tested every time a new substantial data point comes out, and the jobs report is an exceedingly important one. We didn't get that on Friday, but we certainly got that delayed reaction today. Right. And that, coupled with an uptick in geopolitical concern, is really what moved the market substantially higher in both gold and silver.
Yeah, well said. I mean, Gary, you and I were talking a little bit about the U.S. dollar. Obviously, we've seen a decline on the price. The dollar index is still on a decline, indicating maybe a softening stance against a basket of major currencies. How does the current weakening impact commodities like gold or silver? Is there anything that we should be looking at here, typically inversely related to the dollar's strength?
Yeah, as you correctly pointed out, there's 100% negative correlation between the price of silver and gold and the dollar, because both silver and gold are paired with the dollar for value. Right. So if you remember, if we look back to, let's say, pretty much March of this year, we had the dollar coming down. It finds support just below 102 on the dollar index. And from 102, it travels as high as 106 and change. So that's a 4% gain as it relates to the currencies, the basket of currencies that it trades against. Now, last week, and we're looking at a daily chart. So Friday, Thursday, and Wednesday. Wednesday is when it hit its highest value in quite some time, but it closed much lower. That was a point in which either profit taking came in, but it was unable to break and close above that. So it was a signal to liquidate and pull profits for traders that were long the dollar. It was also a signal for shorter term traders to actually go in and sell that market. And that's why we got a strong move to the downside. We had 3 solid red candles in a row. And that is a candlestick pattern that indicates a continuation of selling. However, today we've got really an inside trading day. not from the real body, but from the total range of the dollar. The dollar traded to a low of 104.40 on Friday and a high of 105.24. So you had a very solid range. What I was impressed with the dollar on Friday was after hitting these lows, you can see where it closed. That's the bottom of this real body on a red candle. So it traded to a extreme low when you consider that it opened at 105.19, went down to 104.40, so almost a 0.7% move to the downside, but then it recovered quite eloquently, still closing lower on the day, still trading with a lower low, lower high, and lower close. Today it came in, it opened just below the close on Friday. It closed just above the close on Friday, but it wasn't solid in any means. It was a very small bodied candle, and candlesticks, we call it a spinning top. It doesn't signal a reversal yet to the upside, and we could see a continuation throughout the week of the dollar going lower. We'll have to see if it recovers tomorrow, or if we get a close that's below, call it 104.7.
Okay, 104.7. Very interesting, especially with the economic data coming out and, of course, the printing of the dollars, watching these dollar price movements, that's for sure.
Absolutely. And realize that during the FOMC meeting that recently occurred, they left interest rates unchanged. B, they talked about that they really need to see something in terms of movement before they consider cutting rates. They might have less rate cuts. Most analysts are penciling in 1 or 2 rate cuts. I still believe that they'll try to squeeze in 2.
Okay.
But that could be an incorrect assumption. The one thing that you want to look at when we look at something like this is how all of these markets work together, and the dollar being absolutely sensitive to statements by the Federal Reserve. And what was most interesting about what we saw was that although they did not cut rates and they left them where they are, they made an important announcement about their liquidation of their asset balance sheet, because the Fed has been pulling money out of the money supply at about 95 million, I believe. It could be billion.
Yeah.
The numbers are so large, they confuse me sometimes. $95 billion per month. And so what they said is that they're going to continue to pull money out of the money supply, liquidating assets from the balance sheet, but they're going to do 30 billion less per month. So they're only going to be contracting the money supply by 65 billion rather than 95 billion. So they're still contracting, but they're leaving an additional 30 billion per month that they weren't leaving in prior to that. And that's an important thing that the Fed has done, because aside from interest rates, that is the other effective tool in their toolbox to deal with inflationary pressures, is balance sheet reduction, QT, or adding to the balance sheet, which is QE.
Yeah, very important to watch the quantitative tightening starting to take place, Gary. Before I let you go, because we're almost out of time, I want to talk a little bit about Bitcoin. I mean, obviously we had that sharp rally and then Bitcoin experienced a significant correction. And I think it coming down around the 58,000 at some point there. Take a quick look at this chart. What are the technical patterns and indicators like RSI or MACDs? What do they suggest about Bitcoin in a rebound, or are we going to face further corrections?
Well, I've got a basic daily chart of Bitcoin. And when we look at that, I've drawn in some channel lines as well as a fib retracement from 3,800, 500 up to this record top at around 73. When we do that, we see that 60,300 is a potential level. We can see that we had these wicks come into the area, but we would close above and it moved up. But what we're really seeing is ever since hitting these highs, we came down to about a 38.2% fib retracement at 60,300. We moved to a lower high here, a slightly higher high than this high, but definitely it was a lower high than the all-time record high. And from there, we can see that it kind of moved from upper level resistance down to a level of support, back to resistance. Support is where it bounced off of early last week or a week ago, a little bit over a week ago. You've got Friday, Thursday, Wednesday, Tuesday. This would be Monday's candle last week. Mm-hmm. And so now it's right at this line, which would suggest if it continues in the channel, which is obviously a downward bias channel, that it would come down and test this area. However, what we look for in a channel line is either a break below or a break above the upper level channel line. So if we see Bitcoin, for example, rather than trading lower over the next day, actually having an effective close above this price point around $63,000 per ounce, then we would look at various levels. 65, 66, 70, and 71 would be the levels we'd want to see Bitcoin take out.
Okay, you were talking a little bit about major support if it came off as well. What's that around, the $56,000 mark?
Well, yeah, major support, and I've got it in red as the 50% retracement. It has not really tested that. You've had some wicks or lows that came in close to that last week. This is Monday and Tuesday of last week, but it effectively closed back within the channel. So what I'm seeing is potential support if we get this market to either move sideways or higher or even a little bit lower is going to be about 60,000 to 60,300, the 38.2% retracement, because those were tested a few weeks prior to that. If it does break out above this, I would look for a move very quickly above $65,400.
All right, $64,500. Gary Wagner charting it all out for us today. Of course, Gary Wagner, thanks for coming on. I appreciate your time. We're going to have to look at these levels and maybe get you on a little sooner.
You got it. You got it. Great to be here.
Thanks, Gary. Have a great week. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for tuning in. Don't forget to go and like that video. Heck, even leave me a comment. I read them. We'll see you next week.